So welcome to today's masterclass for the Executive Diploma in Financial Strategy. My name is Pagan Aspinall. I work in the recruitment team and I'll be the host today. So the aim of today's session is really just to give you an idea of what it would be like if you were to join us and what it would be like studying with us. So I'm going to open up by talking about what you can expect on the programme, and then I'll hand it over to Ken Okamura, our programme director, who's going to deliver the taster lecture on the future of the auto industry. We do have a Q&A box, so if you have any questions as we go along, please do put them in there. Just to let you know as well, this session is being recorded, so you will receive the recording about a week or within the next week or so. So what is an executive diploma? That's a question that we get asked quite a lot here. First of all, I just want to point out the image that you can see on the screen. So this is Saïd Business School, taken from the point of view of our outside amphitheatre at dusk. We are the business school based at the University of Oxford. So yes, we are very much part of the University of Oxford and that historical institution. At the business school, we have a wide portfolio of executive courses for busy senior executives who, have full-time work commitments, who don't necessarily want to quit their jobs but want to study, part-time. And as part of this, we have the executive diplomas. They were created kind of off the back of our successful executive MBA. So as you might be aware, the Executive MBA is a 2-year programme, which is quite a general degree that focuses on a lot of different business topics. What we decided to do is to take areas of the Executive MBA and carve them up and make it a standalone qualification, and that's how the Executive Diplomas were created. So we have a diploma in global business, organisational leadership, strategy and innovation, AI and business, and financial strategy, which is the one that we're going to be talking about today. So the Financial Strategy Diploma is a 1-year programme and it's part-time. So within that year, you come to Oxford 4 times, and each time you're here for 4 days of teaching. The qualification that you receive is a postgraduate diploma. So it's a level 7 qualification, which is the same level as a master's. It's not a full master's because there's not enough credits. But if you do want to convert it into a master's later down the line, that is something which is possible, and I'll talk about later. But it is very much an accredited qualification from the University of Oxford. In terms of the teaching on the programme, it's highly practical. So we're aware that you're all going to be working professionals, and the idea is that we are going to give you the tools that you can learn in 1 module week and go back to your office the next week and already start to implement that knowledge. So it's very practical, it's very discussion-led, there's a lot of collaboration in the classroom, and all of our lecture theatres are shaped in this kind of amphitheatre style. And the idea is that you can see everybody in the classroom. The lecturer will, call out for people to share their ideas and their experiences, and you're really learning from your peers as much as you are from the professors and the guest lecturers. And of course, it's Oxford, so it's academically rigorous, and we'll be teaching you about theoretical concepts. The good news is it's not too late to join our next cohort. So we have 1 intake per year, and the next intake is starting in January 2025. And the course fee for this year is £33,900. So in terms of the structure of the programme, I'll just quickly go through this in the interest of time, but it starts in January every year with a module in strategy. Following that module, you go back home and you're given an assignment to write, which you then submit, and come back a couple of months later for the next module, which is business finance. Following business finance, there is an exam that you do. So you spend a couple of months revising for it, and then you come back in July for your corporate valuation module. And the first thing you do in the morning is you sit your exam. Following corporate valuation, there is another assignment that you have to do, and you come back in October for financial strategies for growth. Following the final module, we get you to do a 6,000-word project called the Final Integrative Assignment. And the idea of this project is that we want you to take an area, a challenge that you're facing in your company, in your business, and we want you to think about what you've learned on the programme and how are you going to use that knowledge and those tools to fix this challenge. So it's a highly practical assignment that you can use to sort of implement in your day-to-day life. You get 3 months to write that assignment, and then you come back 6 months later for your graduation celebration. So what can you expect from your fellow classmates? Well, this group of lovely people here are our cohort, which has just finished about a month ago, our 2024 cohort. This year we had 32 participants. That's quite average for financial strategy. We normally have about 30 to 35 participants. And within that group, it's highly diverse. So even though we had 32 people, we actually had 23 different sectors represented from areas like tech, healthcare, manufacturing, finance, aerospace. So quite a wide mix of people. And also we had 21 different nationalities in the class. The average age was 41, which again is quite typical. So that represents about 15 years of full-time work experience. Like I said, this is a program for senior executives with many years of experience. And talking about the diversity, I just wanted to show what that looks like exactly on a map. So again, this is the class of 2023. As you can see, every continent was represented. We had people coming from North America, a lot of people from Europe, UK, Asia, and Africa. But also people came from quite far away. So we had some people from Australia, we had someone from Colombia. So it really is a big pool of people with diverse backgrounds, which is something that we have every year in every cohort. And we really design it this way because we want you to learn from people from different backgrounds, different regions. So yeah, I think that's definitely one of the advantages of studying with us. And one of the other advantages of studying this programme is that upon completion, you will join the Oxford Business Alumni Network. So this is a thriving community of around 24,000 members all across the world. These cities that you can see on the screen, these are our regional chapters. So in each of these cities, there will be a chapter ambassador or chapter ambassadors who organise meetups and networking events within that city, within that region. There's lots of benefits to being part of the alumni network, including getting access to library databases and 5 years, 10 years, 15 years out of the programme, you will be invited to events back in London, back in Oxford, with senior faculty and members of the business school. So yeah, lots of benefits there. Okay, now I mentioned at the start that there was the possibility to convert this diploma to a full master's. We have the pathway to the Executive MBA programme. So you do need to apply to this programme. It's not guaranteed entry. But after doing the diploma, if you do want to convert it to a full master's, then you can apply to this programme and you will receive exemption from 4 module assessments, as well as a fee reduction, which is 60% of what you paid for the Executive Diploma is taken off the Executive MBA bill. And we do find that a lot of our diploma students do this option. You know, they really get a lot out of their Oxford experience and you know, want to convert that to a full Executive MBA. So that's the diploma in a nutshell. What I'm going to do now is I'm going to hand it over to Ken, who is going to deliver the taster lecture, and then I'll come back at the end for questions and further information about the application process. So over to you, Ken.
Thank you, Pagan. Okay, so my lecture today, the taster lecture today is about Toyota and the rest versus Tesla, 2 T's. Subtitle is The Machine That Changed the World versus Smartphones on Wheels. The Machine That Changed the World is the name of a book written in the 1980s about the remarkable kind of results of the Japanese car industry, which came along and delivered quite remarkable performance. And basically 50 years on, we're at a point where there's a certain amount of discussion going on about what's going to happen to the future of the auto industry. So just to kind of look back, what do we do on the course? We basically teach you financial strategy. I'm going to talk about finance first because I'm a member of the finance faculty. I tend to teach finance components of the program. Finance is all about what's a company worth, how should it be financed, how should it be controlled. It gives you all kinds of insights, tools, etc. And strategy, the other half of what comes into the diploma, is it's about how to generate value through competitive advantage, and how one should allocate resources and make choices about how the company is organized, about where the resources of the firm should go. The strategic choices result in future cash flows. Those future cash flows are basically what we value. And I'm going to take the opportunity today to talk a little bit about how to think about the auto industry using both a finance and strategy lens. So for those of you who have been reading the press, there's been a lot of news coverage recently for the German auto company Volkswagen, because they've turned around and said that they want to close 3 factories out of the 10 they have in Germany. It's the first set of compulsory redundancies they've talked about in 3 decades. So roughly around the time that the Japanese were expanding quite dramatically their market footprint in the kind of late 80s. And once again, we're back to a situation where the Volkswagen, which is the second largest of the global car companies after Toyota, is finding itself in difficulty. Why are they finding themselves in difficulty? Well, basically for this reason, and this also affects Toyota. So Toyota basically controls about just over 10% of the global car market. Volkswagen controls just under 5% in terms of sales. But they're falling behind in what's considered to be the dominant kind of factor going forward, which is the rise of software as a proportion of the value of the company. Oh, by the way, if anyone has any comments or questions, do put them into the Q&A, and I'd be happy to try and answer them or address them as we go forward. Okay, so why is falling behind in the software race such a problem? Well, it's considered to be a problem mainly because of the fact that over time, the expectation of pretty much every market observer is that digital revenues as a proportion of total car industry revenues is going to become predominant. So at the moment, digital related things are somewhere around kind of 30%. And most of that 30% is still being picked up by the big car companies because we're talking about the electronic innards of the car. But we know that in fact, increasingly as software becomes more important, the car companies find themselves unable, or the legacy car companies have found themselves unable to compete. and they're particularly under pressure from newcomers like Tesla. And why is it Tesla is better at this? Well, because electric vehicles, which is all Tesla does, are incredibly dependent on software. They use software to improve the driving of the cars. They use software to improve the efficiency of batteries. And it's just not as important for legacy internal combustion engine car companies, which means that the legacy companies find themselves at a major disadvantage. So remember, I was talking about the major disadvantage. That major disadvantage is because of the fact that the auto companies find themselves facing this major disruptive change. And this disruptive change is the shift from the internal combustion engine to electric vehicles. But there's a second thing that's on the horizon, which is the rise or the potential rise of autonomous vehicles. And the autonomous vehicles represent an enormous shift in the nature of the automotive industry. And inevitably, car companies that are producing electric vehicles, given their advantages in terms of the software, find themselves in a far more advantageous position to potentially deliver autonomous vehicles in the future. Yes, I'm certainly, I don't believe that it will happen in the next 5 years, contrary to the prognostications of Elon Musk. But we do know that self-driving vehicles, or at least semi-self-driving vehicles, are a possibility on the kind of 10-year horizon. And this then means that there is a threat to the existing car companies. There's also the fact that the demand that car companies should reduce their emissions means that there's a great deal of pressure on car companies to shift towards the idea of electric vehicles over kind of standard internal combustion engines. So if we were to look at the share prices of the firms, basically, if we look at share prices since 2014, up until kind of just before the pandemic, they were all kind of moving together. It's true that Volkswagen has done slightly worse, and Toyota has done far better than Volkswagen. So Toyota's share price is roughly double where it was in 2014. Volkswagen's is basically nearly half of where it was, but Tesla's share price has basically risen 16 times. Now, if we actually, on the hand, Tesla was kind of cheap back in 2014, or not cheap, but it wasn't worth a lot in 2014. But if we look at market capitalization, so you can see that in 2014, the value of the equity of Tesla was worth far less than the value of Volkswagen, which was worth less than the value of Toyota. And you can actually see that in around the time of the pandemic, Tesla has overtaken both Toyota and Volkswagen in terms of market capitalization. And so you can make the case that there is basically one winner from the rise of electric vehicles and potentially autonomous vehicles in this particular kind of set. Interestingly, BYD, the big Chinese company, is worth quite a lot, but it is not on the scale of Tesla, which really has kind of run away and looks like a huge winner. So there are questions about how the legacy producers can fight back. These are all kinds of ideas that you would cover in the strategy classes. The legacy producers can fight back. They can try and buy some time. So this plays to their strengths. Legacy producers are still really good at building cars. They have quite significant resources in the building, the efficient and cheap building of cars. They're very good with internal combustion engines, and they can build hybrids. Hybrids actually have relatively low emissions, and in fact, Toyota is making a lot of money from hybrids at the moment. So this is an example of where they are playing to their strengths. They can try and fight back by innovating, which is to throw money into the possibility of finding a solution. The problem with innovation is it's expensive, you can't guarantee it's going to work, and inevitably it tends to run into problems internally because there are always internal interest groups who are opposed to some of the new developments. So Toyota has a subsidiary that specializes in kind of software. Their losses have come to 900 million. They've undergone yet another kind of high-level corporate turnover, where the head of the company has stepped down. Now Toyota is talking about creating a joint venture with NTT Docomo of 3.3 billion, where they're going to try and work on things around autonomous cars. So innovation, it's a possibility, but inevitably, if you look at the strategic problems with stuff like this, a lot of it is tied to the fact that internally there are usually interest groups that are opposed to particular kind of goals, etc. The larger the organization, the more complex these things are. And inevitably, there tends to be an element of, well, we're making a lot of money now. Do we really need to worry about it? You can actually buy it in. So I think it's VW, might be BMW. Anyway, they've actually been, they spent $5 billion using technology from Rivian, another kind of electric vehicle kind of producer. We also see a lot of acquisitions by the legacy car makers of tech companies. Does this work? Well, it tends to run into the same problems as innovation, which is that other interest groups within the company may not be willing to use or are unable to fully kind of utilize the technology that's brought in. The classic example of that historically is Nokia's acquisition of Symbian. So Nokia big phone set manufacturer. They bought one of the very first smartphone software companies, Symbian. Symbian had actually been ahead of the pack. Nokia bought it, promised to throw a lot of resources into it, but it ran into the problem of the fact that there were other groups within Nokia who were trying to do innovation, and in the end, Symbian disappeared with Nokia's attempts to develop a competitor to the iPhone and to Samsung smartphones. Legacy producers can fight back by allying with technology companies that, excuse me, are not direct competitors. So Apple has a CarPlay. Apple's CarPlay is a app that will actually control certain aspects of the car. So Porsche has actually launched a compatibility with its latest kind of sport SUV that allows Apple's CarPlay greater control. The problem with allying, of course, is that you're giving away part of the critical kind of software development, which is the reason why other car companies have refused to make it easy for Apple to operate within their cars. Historically, big legacy companies have always had a big advantage because they're big. They have long-standing relationships with the government, and so they can engage in a non-market strategy to try and prevent their competitors coming in. If you look, for example, at the banking industry, the banks have been incredibly successful at lobbying for protection. Of course, they don't necessarily call it lobbying for protection. What they do is they couch it as it's an attempt to try and ensure that the financial transactions are safe and that people are protected. But this has meant that there are many, many barriers to new fintech companies and new upstart brands in finance breaking in. You can also weaponize existing kind of legislation. And so the big banks are very, very keen on kind of anti-fraud, anti-money laundering measures. And so know your customer AML controls actually form a barrier to entry for new startups. And so this non-market strategy can be very, very successful. Unfortunately for legacy producers, they're actually up against an even larger juggernaut in the form of the demand for climate action. As a result, there are EV mandates in Europe. The Biden administration has been pushing an EV mandate, and we see pressure for electric vehicles everywhere, which inevitably means that although the legacy producers can try and lobby for protection, they find themselves in a position where they are not sufficiently large relative to the forces on the other side. But it doesn't mean that they can't still use their political connections, their contributions, their economic weight to delay the mandates and to strengthen their position. And you're seeing this to some extent. To be fair, it's also true that in the case of Volkswagen, they find themselves in difficulty partially because of their connections to government. Okay, here is the state of play. You can see that Tesla has revenues of just under 100 billion. Toyota has revenues of about 303 billion. Volkswagen has revenues of 350 billion. The earnings before interest and tax, Toyota is the highest at 36 billion. Volkswagen is still making 25 billion, and Tesla is making a measly 8 billion. And yet Tesla is bigger than Toyota and Volkswagen. So what I'm going to do now is I'm going to try and use some finance techniques to think about what the financial markets are discounting as far as the future of the car industry is concerned. And I'm going to focus primarily on Toyota and Tesla because this is slightly easier. So I'm going to value Toyota using one of the standard workhorse models, which is the dividend discount model. So we assume that the share price today is the discounted present value of all future dividends. So dividends are the actual cash payouts to shareholders. And in this particular model, we're going to assume that dividends grow constantly. So they are what we would call a growing perpetuity. We're going to ignore the debt. In the case of Toyota, it doesn't really matter that much because pretty much all of their debt is actually motor finance debt, which is to say that Toyota has taken on the debt for Toyota automotive finance, but it is exactly matched by lots of people borrowing money from Toyota automotive finance to buy cars. So on a net basis, Toyota doesn't have any debt. But in all dividend discount models, we ignore the debt because we're assuming the debt is sustainable and will be able to be paid out. And all we're interested in is the value of future dividends. So this is how the dividend discount model works. The share price today is equal to the sum of all future dividend, the dividend in a year's time, which is discounted minus the dividend growth rate. So we're assuming the dividend is going to grow at a constant rate, and the discount rate remains stable, and that next year's dividend is a good indicator of what all the future dividends will look like. So these are the components. So Toyota's share price at the moment is just over or just under 2,700 yen. Their estimated dividend in a year's time is around 87 yen. And I've estimated their cost of equity capital using the capital asset pricing model. For all of those of you who are not familiar with these things like the capital asset pricing model, we teach you all of this stuff on the course. You will learn all these useful little tools allow you to try and work out exactly how the company's cost of capital works, which is the required return by the shareholders of the firm. And so the capital asset pricing model works by looking at the beta, which is the sensitivity of Toyota's share price to the overall market, the overall economy, the risk-free rate, which is taken from Japanese government bonds, the equity risk premium, which is taken from Aswath Damodaran's site, and I calculate their cost of equity capital to be about 3%. So this allows us to throw all the numbers together, and the share price is equal to the dividend in a year's time divided by the cost of equity minus growth. We have the cost of equity, we don't have the growth rate, but we do have the dividend, we do have the share price. And what we find is that, in fact, the expected long-term growth rate is minus 0.15%. which is to say that, in fact, in the long run, there's an expectation in Toyota's share price that their dividend will begin to shrink gradually over time. That's certainly not the expectation in the next 5 years, but the whole point is that the long-term growth rate, if we throw it into a dividend discount model, says that it's going to shrink over time. If we use the US dollar and industry betas, we'll end up with a very, very different growth rate. So there's a differential partially caused by differences between US and Japanese inflation rates. But what I want you to take away from this is that Toyota's current share price reflects an expectation that perhaps in the long run, it's going to shrink. How are we going to value Tesla? Well, Tesla has no dividends. So we're going to value the enterprise value, which is the combination of both debt and equity as a function of future free cash flows. And again, we're going to assume that all free cash flows are a growing perpetuity. Here are the components. Tesla's enterprise value is $806 billion. The estimated free cash flow for the next 12 months is about $7.4 billion. Here is Tesla's estimated cost of equity capital using the capital asset pricing model. So it has a beta of 2.3. The risk-free rate taken from US government bonds is 4.3%. Equity risk premium 4.12. Cost of equity capital is 13.75. The Tesla's weighted average cost of capital is a combination of their debt costs and their equity costs weighted by the proportion of equity and debt in their balance sheet. But it turns out their debt to value is basically about zero. They have a certain amount of debt, but it's actually dwarfed by the cash. And therefore, basically, I'm going to assume that the cost of equity is their cost of capital. Not particularly true, but true enough for our purposes. And so what we find is that at the moment, remember they have free cash flow of $7.4 billion. The enterprise value is $806 billion. That's 0.9%. So the implied growth rate of Tesla is just under 13% per year, which is quite enormous. Remember, I said Tesla appears to be the one winner in all of this. Well, Toyota, the largest car company in the world, expected to grow its dividends negatively over time, and Tesla is expected to grow dramatically from here. So what does all this mean? So in the short run, Toyota and VW are going to continue to generate quite significant profits and dividends, and they're going to actually grow a little bit. That means that in the long run, the possible negative growth rate is much higher. In other words, at some point in the future, it's possible that Toyota and Volkswagen will disappear. That's what the share price means, because over the next 10 years or so, Toyota and VW are going to generate quite significant returns. But at some point in the future, it's possible that they're actually going to shrink and disappear, which is to say that effectively, the car industry is going to change fundamentally. It's also true that Tesla's share price may be linked to other tech developments. They are involved in energy storage, random solar things, and so it's not all necessarily the car companies. But it is definitely true that the auto industry is going through a major kind of realignment. So, how likely is Carmageddon? I rather like that phrase, Carmageddon. So this would be an Armageddon for the existing car companies. And basically, we need to think about the industry and um, basically, what is the car industry? The car industry is about personal ability. It's allowing people to move around much more freely than if they were dependent on public transport, or if they were walking or riding horses or riding bicycles. Um, and the step change is not about electric vehicles. Electric vehicles are simply a way of changing the propulsion mechanism. Um, it is true that Toyota and Volkswagen are behind Tesla at the moment, but they are working on things like battery technologies, etc. It's not clear necessarily that the change in um, the engine is the step change. The step change is really about autonomous cars. And the reason why this is the case is that autonomous cars will quite massively reduce demand for the number of cars on the road. So the figure is that over 90% of the time, cars aren't being used. If we could actually share cars, we don't necessarily need to have our own personal car. So there is an issue over the timing of when people are in their cars, etc. But it is definitely true that Carmageddon would be driven most likely by the rise of autonomy, because autonomy basically means that the software is far more important. And because getting the car to the right place, understanding the patterns of who's going to need a car when, etc., all of this is going to be incredibly important. So the car itself, making the car cheaply, is going to be less important than having the car in the right place. This is why the software is important. It's also true that timing is going to be important. When do we actually get true level 4 and level 5 autonomy? Level 5 autonomy, by the way, is you're drunk and you're asleep in the back of the car. You don't need to do anything. Level 4 is that you are able to do other things and you're only kind of called on under certain extreme circumstances. At the moment, there are only 2 level 3 car models that have been approved, and we're still a long way from level 4 and level 5. But financial markets are really kind of pricing in Carmageddon. So how should we think about this? There are some massive shifts that have occurred that actually kind of did see huge incumbent players dethroned in a matter of a few years. So Nokia, which we've talked about before, they dominated GSM handsets. And then the smartphones came along and they basically kind of saw Nokia go from a dominant position to being a non-participant in the handset market within a decade. And again, this was well telegraphed, but it was relatively quick. The rise of kind of the smartphones took place over a relatively short period of time. Similarly, in the 1990s, there were a whole load of big telecom manufacturers, Lucent, Nortel, Fujitsu, Alcatel. They were wiped out by the rise of Cisco and internet routers. Within 10 years, a significant number of the companies involved in this sector were wiped out. These are the people making automated switchboards. Suddenly, the industry changed quite dramatically. However, the change for Carmageddon, it's slow. I mean, people have been talking about autonomous cars. They've been talking about kind of electric vehicles, and it's actually taking a long time. It's not going to be as fast as the shock to Nokia or the shock to the big telecom manufacturers. It is incredibly well telegraphed. Everyone knows these things. That said, Nokia knew that smartphones were coming. The big telecom manufacturers could see internet routers coming. You can see other examples of this where companies knew a shift was coming but were unable to adapt. So Eastman Kodak, producing kind of film-based cameras, or rather they were selling film. They knew that digital was coming. They produced the first digital camera back in the 1970s, but they didn't survive the shift because they were still too wedded to the previous kind of incarnation. These are all kind of strategy-related things and the kind of stuff that we will teach you on the program. So, to summarize, what will the diploma do? It will show you stuff about strategic responses and frameworks. We will teach you how to apply them to your business, to actually not just businesses, also to non-profits, to governments, etc. We'll teach you a lot of finance techniques, so how to value companies, to understand the financial choices that can be made, how to combine all of these things, and to use this stuff to analyze kind of questions and industries, etc., which is the thing that I've tried to do in this little taster lecture, where we've looked at what's happening in the car industry. Are there any questions?
Thanks, Ken. Yeah, I think we've had quite a few. So the first question we have is, from your point of view, do you think Volkswagen can overtake the advance of Tesla and BYD?
I think the odds of any of the legacy car companies overtaking Tesla and BYD are low. I think that the probability that they will catch up with all the relevant technology is probably less than 10%. A big chunk of this is because they don't have the relevant skills. Another reason is that they are still kind of wedded to doing things in a certain way. And you see this, you saw this in the big telecom manufacturers. They all saw the threat of Cisco systems coming along, and their position was, but our stuff is so great and so good. Who wants these horrible internet routers anyway? It turned out everyone did.
Yeah, great. Okay, thanks. We've got a few questions from Jad. So his first question is there a study that actually shows how much fuel does it consume or cost to charge an electric vehicle versus how much fuel is consumed to cover the same distance?
Yes, so there are multiple studies that look at the cost of building an electric vehicle, the cost of fueling the electric vehicle, plus there are issues over recycling of the old batteries. The running costs much lower, but well, lower in terms of carbon emissions. It turns out that actually not scrapping old cars and running them forever actually has a pretty good effect in terms of carbon emissions. Not a popular view with the people in favor of climate change or climate change mitigation. But yes, there are lots and lots of studies that look at all these things.
Great. And why isn't BYD in the news versus Tesla, as BYD has relatively the highest electrical vehicle sales?
They've only just gotten to the point where they have the highest electric vehicle sales. And the answer to that will probably be because BYD is in China, Tesla is in the States, Elon Musk is a great salesman. BYD is actually in the news a fair amount. I didn't cover them today, mainly because of the fact that I needed to kind of thin things down to a couple of companies. But BYD is another potential big winner in this space. They're much more likely to run into difficulties internationally as a result of the trade wars and trade pressures. So both the Europeans and the Americans have been talking about trying to slow the advance of BYD.
Yeah, okay. And then last but not least from Jad, are electric vehicles destined to be the final future vehicles, as there are ongoing successful tests on other power sources, tech and fuel sales as potential manufacturers?
The answer to that is, if I knew that, I would be retired and rich. EVs are a problem. Well, the current generation of EVs are a problem because lithium doesn't actually have the energy capacity to power vehicles over the required distances. There are attempts to try and improve lithium ion. I think that at some point in the future, we will get significant shifts in the battery technology. That's probably at least 10 to 15 years away. Everyone talks about hydrogen. I just don't think that there's the infrastructure making it, storing it, distributing it. It's a cool idea, but it's also very hard to do. Yeah, so it's not the final thing, but it will certainly be a significant kind of player over the next 10 to 15 years.
Yeah, okay, thanks. And that leads into another question we've had about the hydrogen car and the fact that Toyota were coming up with a hydrogen car. How do you think that would play into this scenario? Would that be another inflection point, or do you think that's a no-go area?
Yeah, so the Japanese car companies have been playing around with hydrogen since the 1980s, and every so often one of them blows up very, very energetically. At the moment, I don't see hydrogen as a significant competitor, given the amount of pressure there is for EV mandates, and given the costs of building the hydrogen infrastructure. It's a cool idea. It may be that it'll end up like the steam-powered cars that were beaten out by the internal combustion engine at the end of the 19th century. Cool idea, just didn't work.
Yeah, absolutely. Okay, another question here. I think this might be one of our final ones. What do you think caused the problems at VW? Mismanagement? They have been an experienced manufacturer. Do you think there was a gap of technology competence?
There are so many reasons. A big one is corporate governance, which is a finance topic, which I like to talk about. Finance topics are excellent. So corporate governance is to do with the alignment of the providers of capital and the management. And there is the issue of the fact that Volkswagen has shareholders such as the local state government that puts pressure on them to maintain the workforce. There's also a big family influence through the Porsche peer family, and all of these things mean that the incentives for the management haven't necessarily been the right ones. There are many others. One is some is technology, some is to do with stuff around Dieselgate, where it turned out that it was very hard to create efficient diesel engines, and they came up with a cheating solution, which led to them being caught. Partially that's a governance issue, partially that was a technology issue. I'm happy to discuss that if you come on the course.
Excellent, great. Another benefit to come in and enroll in with us next year. Okay, I think we'll make this the final question. Do you foresee CNG becoming a dominant competition against EV?
CNG, I'm not sure what you mean by CNG.
Me neither. I'm not aware of that acronym. Maybe Isaac, if you can clarify what you mean by that. But if he's still around. Okay, I think Isaac might have dropped off the call who asked the question. But yes, if you do have any follow-up questions. Oh, someone said compressed natural gas.
Compressed natural gas. Compressed natural gas is still it's still basically a fossil fuel, or is very unpopular with the climate people. It's cleaner, but it's not popular relative to EVs. CNGs, you see various kind of versions of this floating around in places like Japan, but I don't see it as being anything other than a temporary stopgap solution in the same way as hybrids.
Great, thank you. Okay, I'm really sorry, there's a few more questions, but I'm just going to quickly finish things off because there are a few things I want to address before we finish. Thank you very much, Ken. Let me just share my slides again. Okay. Hopefully you should all be able to see that. So hopefully this session has really inspired many of you to apply to be part of our next intake. Good news is not too late to apply. You have until the 25th of November. In terms of the candidates we're looking for, as we've addressed, we're looking for senior executives. The minimum is 5 years relevant work experience, but that does need to include sort of senior managerial experience. We look for candidates that have a bachelor's degree, ideally in upper second class. But if you don't have that, but you have significant work experience to compensate, then that also might be something that we can consider. If English is not your first language, then we do need evidence of your English language proficiency. Most of our students will be using English in their working professional lives. If that's the case for you, all you need to do is upload a short statement to your application, just a few sentences explaining your English language ability and how often you use it and in what capacity, and that should suffice. Good news is there's no GMAT or GRE, but you do need to provide us with a one-page, ideally no more than 2-page CV, academic transcripts of previous degrees that you've studied, if you have a bachelor's or a master's, 2 references, and there's also 2 short essays. All of the detail of this is on our website in the application form. The first essay, you need to discuss your motivations for doing the programme, and the second essay, talk about your greatest achievements in your current role. So you submit your application through our website. There's no interview process. A few weeks later, you will receive your decision. Okay, just wanted to flag an upcoming event as well that we've got is an application help desk, and you can register for that by scanning the QR code. So this is not a webinar with a presentation, it's a drop-in session. So if you have specific questions that you want answered, then my colleague Marta, who's been helping us out with questions today, she will be leading that session and will be able to help you. I would love to hear from you. If you've been inspired by today's session and want to apply, then please connect with me. Here are my details. I'll leave that up on the screen for a minute for you to make a note. But just want to finish off by saying a huge thank you to Ken. That was really interesting discussion. It's obviously inspired a lot of questions. I can still see the red thing flicking up. So thank you very much. And thank you to all of you for coming along today. Like I said, this session has been recorded, so you will get sent that within the next week. But thank you again, and hope to hear from you very soon. Have a good day.